Hey guys, Assalamualaikum. Welcome back to another virtual lecture. In this video, we're going to take a look at several of the strengths as well as problems of the monetary policy. Let's take a look at the strengths of monetary policy first. Now, as compared to fiscal policy that may involve rounds of debates and arguments in Parliament with regards to the tools of fiscal policy, namely government spending and taxation, monetary policy can be altered rather quickly. Therefore, it is argued that monetary policy is speedier and more flexible as compared to the fiscal policy. And as you may have remembered, all of the tools of monetary policy would lead to changes in interest rates. Now, changing interest rates can be quite effective as they involve no time lags as compared to the fiscal policy. Therefore, it is also argued that monetary policy is more preferred method of monetary control. Now, since the members of the Board of Governors of the central banks are appointed, they are relatively isolated from lobbying and they did not worry about retaining their popularity with voters. Therefore, it is also argued that monetary policy has more isolation from political pressure. However, there are also some problems related to monetary policy because, as you know, there's no such thing as a perfect policy, right? Just like fiscal policy, monetary policy also suffers from recognition and operation lags. Okay, so these may complicate the timing of monetary policy. Just as the economy starts to recover, perhaps that is when the effectiveness of monetary policy will come into play. So it might cause different kind of problems, okay? Besides that, another problem of monetary policy is the cyclical asymmetry. Now, cyclical asymmetry is basically the idea that monetary policy may be more successful in slowing expansions and controlling inflation rather than during times of severe recession. If the economy is experiencing a recession and the central bank decides to implement an easy money policy, they can do that. However, the central bank cannot make the commercial banks give out loans. The central bank cannot force people to borrow money from the commercial banks. So this is the kind of thing that may affect the effectiveness of monetary policy. Related to the cyclical asymmetry is the problem of liquidity trap. This is the case where despite having low interest rates, people somehow they prefer to hold money. They just don't want to spend. Maybe they fear of the inevitable, maybe they fear war or deflation, etc. So because of that, even when there is an expansionary monetary policy happening, it will not be that effective. In other words, expansionary monetary policy will not have any effect on interest rates or income levels, and it will not stimulate growth. Now, the next point isn't really a problem for monetary policy, but rather monetary policy somehow will change the velocity of money. Now, velocity of money is basically the number of times a year the average money is spent on goods and services. In other words, it is the rate at which money is exchanged from one transaction to another, or the rate at which people spend money. Now, during times of recession, so obviously the central bank would adopt an easy monetary policy, right? When there's an easy monetary policy, people will hold a lot of money, right? Therefore, the velocity of money will fall because there's just a lot of money in the market. So money will not be exchanging hands that often. Whereas when there's a problem of inflation, a tight monetary policy will be implemented. This will lead to a high velocity of money because the amount of money in the market is very much tightened or less. So therefore, the same amount of money is being exchanged or going from one hand to another quite frequently. Okay, so it's basically just a relationship. Okay, so monetary policy will in fact change the velocity of money. Next is the impact of monetary policy on investment. Now, you may have remembered in the last video, okay, when monetary policy is implemented, it will affect the amount of investments happening in the economy, right? So as you can see here, I've just sketched something quite generic, okay? But in reality, however, the amount of investment really depends on how flat or how steep the demand for money is, as well as the investment demand curve. Okay, so theoretically, the flatter the investment demand curve, the larger would be the effect of changes in interest rate on investment. So these things are sort of out of the government's control. So the central bank can try to increase money supply or reduce money supply, but in the end, the effect on real GDP would well, pretty much depends on how flat or how steep the investment demand curve really is. There's also the conflicting problems of interest as income, because as we know, interest is one of the determinants of a planned investment, right? So we know that planned investment is inversely or negatively related to interest rate. However, households and businesses are also recipients of interest income. So this may, reduce the effectiveness of monetary policy. Now, the last 2 points here, again, is not really a problem, but rather we just want to say that monetary policy do have a strong link with macro stability as well as international trade. For instance, during recession, during recession, the central bank will implement an easy monetary policy, right? So what happens is interest rate will be lowered, and therefore this will reduce foreign demand for the ringgit. So what happens is ringgit will depreciate, and when ringgit depreciates, there will be a positive XN because the total number of export would be more than import. When XN goes up, aggregate demand also goes up, and therefore the real GDP will also go up. So in other words, when interest rate changes, exchange rate will change too. So this will strengthen the domestic monetary policy. Likewise, when we have an inflation, so a tight monetary policy will be implemented. So a tight monetary policy will lead to higher interest rate, which would mean higher foreign demand for ringgit. So the effect is ringgit will appreciate. When ringgit appreciates, the total number of imports is more than export. Therefore, the XN will fall. When XN fall, aggregate demand will also fall. So real GDP will fall, and that is basically how it works during inflation.